What's up, guys? It is Teach Me Tuesday, and we're gonna start off this week with hopefully no issues. Okay, and I just want to, yeah, we're gonna get this thing kick started, guys. The topic today is top loan programs buyers should know about going into 2026. Guys, this is so important. A lot of people think 20% down with a conventional loan is the standard. This you gotta have that in order to buy a home, but that's a misconception. All right, in this video, we're going to talk about some different loan programs that might change your perception or misconception of what it takes to in order to purchase a home in 2026. So let's go ahead and get started, guys. I want to say this. Check out my cup. If you don't see it,
Are you a
we
Patriots fan?
I sure am a Patriots fan,
Oh,
proud to be one. We back in there, so we're gonna keep this train going. I just want to put that in there real quick. All right, has nothing to do with buying a home in
Hey,
2026.
but what a better birthday gift? What a better birthday gift than your Patriots making it back, to the AFC Championship game.
Such a blessing, such a blessing from the Lord, right?
So happy
Right.
birthday, Mr. Wilmot Barrett.
Thank you so
happy
much, man.
birthday.
Thank you. As we continue, all right. Let me ask the professionals why loan program knowledge matters more than ever. Why is understanding loan options so important heading into 2026, guys?
Such a good question. Do you want to take that one, Gab, or you want me to take it?
No, ladies first. Go ahead. Tell us about it.
I mean, loan program definitely matters, right? Because at the end of the day, as a lender, what our job is to really try to figure out that interest rate, down payment. A lot of buyers want to know that information too. And with affordability still being a big challenge in 2026, really understanding the loan program is going to be key because no two loan programs are the same. They all have their pros and cons. You want to also make sure that you're, understanding the apples and oranges of the difference between lenders because one lender may have, an FHA loan versus another lender that has an FHA loan, but there could be a lot of different variations of that product. So just understanding the program, understanding the lender is going to be very key. I think in 2026 as people really prepare for homeownership.
Yeah, I mean, I think what you're saying also is that things are evolving constantly. So
Mhm.
there may have been a traditional way back in the day, and just years ago, to where one loan program could have fit, everybody, or one or two loan programs could have been the options that the majority of people had. But now today we have so many different variations of loan programs that fit your scenario and what you need specifically. So let's dive into it. Let's go to the first one. I mean, just Wilmot threw out in the hook, talking about conventional mortgages, how that the baseline, the standard for buying a home is a conventional loan, putting down 20%. Is that the standard or starting point? It's not.
Mm.
Conventional loans are still very popular. They're probably the most common loan. But as far as needing to put 20% down, that's a myth, or that's just a misunderstanding for a lot of
So
first time home buyers and repeat buyers. Yeah.
so let me ask you this: like, who are convinced? Because I like conventional loans. You know what I'm
Mhm.
saying? So I know as an agent, right? When we are reviewing different loans, because we review the loans that come to our sellers. All right. So we're like, all right, does this loan fit the house? Because all loans don't fit the house. But I do love when I see a conventional loan come across my desk. Who are those conventional loans for, though?
Right. So I mean, if
That's a
you
good
had to
question.
put it in a bubble, someone
Mm,
who's pre-approved for a conventional loan is somebody who has strong credit,
mm,
which in most cases you're talking at minimum 620 or higher.
mm.
Most
That's key.
often they're going to be on the higher side.
I would back that up for conventional, even though that's the
That's the
baseline.
baseline again. But
There you
but
go.
we're talking more likely somebody who's going to conventional loan. If it's not a specific, like a minute reason, they're going to be a 680 or higher in
Mm,
most circumstances. So that just seeing a conventional pre-approval, you're like, man, that person should have pretty decent credit.
Mm,
And then they may also, um, have, assets or strong. They have their own means for down payment,
mm,
in some situations. So I mean, it just means that it's a stronger buyer, and theoretically. However, as we're going to talk about the other loan programs, you'll learn that they're just as approved or just as strong in terms of
mm.
their ability to purchase and affordability. So we'll
Mm,
dive
So
into
I
that
got
as well.
so I have two comments there, right? Just for clarification. Um, I think that there is a huge misconception, I would say, of like you guys mentioned about a myth that you need 20% down and so forth.
mm,
To me, that's not necessarily a myth or misconception. I just think it's like it's a strategy that got kind of twisted into a myth or a misconception of conventional loans, because the person that decides to put down 20%, they're doing that strategically because they want a lower payment. They don't want the private mortgage insurance. But just because you may choose it as a strategy, it may not
mm.
necessarily be the standard. So I just want to make
Right,
sure people understand that.
right.
And then secondly, from a seller standpoint or the selling agent standpoint, when they get a conventional pre-approval, because there's one thing to qualify, like I mentioned, or Gavin mentioned, the minimum credit score for conventional is a 620, and everybody may have their own biases about is a 620 strong credit or not strong credit. That's just, we can answer that question later, right? But truly, for a person to get approved for or pre-approved for a conventional loan, having a 680, having a 720, it makes them a much stronger candidate, and which is why
Right.
sellers may like to see them as well.
S- So if y'all could answer this, because I know that a lot of times us as realtors we look at the loans that come across our desk, right? We had a FHA loan and a conventional loan, right? And both of them had the same offer price point on them. Okay, a lot of times I know a lot of agents we're going to look at that conventional loan, especially if let's say it's the house might have a little bit of age on it, right? There might
Mhm.
be some things about the house that the FHA loan may not approve of, but the conventional loan is a little less strict, if I must say, is the
Mhm.
proper
Mhm.
term to use on when it comes to the appraisal that comes out and
Right.
he assesses the property. It has to pass that appraisal in order for it to qualify for that particular loan. Does a conventional buyer have to have a lower debt to income ratio than a FHA buyer? Can you kind of go into that a little bit? LaShawn Gavin?
Yeah, yeah, absolutely. And that's a really good point that you brought up, Wilmot, is and it's one of those things where I try to tell people that mortgage isn't like black or white, right? It's truly gray. And so
Mm,
it's not necessarily like a hard yes to the answer or a hard no. There's going to be a lot of other factors, right? So
right,
if a
right.
person is just doing a standard FHA loan, the standard FHA loan can go up to 56.99% DTI wise. So they
Mm,
can get a bigger loan essentially going FHA, going FHA. However, FHA loan limits are lower than a conventional loan. So if a person is trying to
mm,
buy, a 600, $700,000 house, they can't
mm,
do that going FHA. But because conventional has a lower debt to income ratio of 50%, then they may be able to do something, bigger and better going that way. So there's a lot of other variables there
right,
that
right.
kind of play a part into that. In addition to once you throw on down payment assistance and things like that, it's something called overlay. So it changes what the standard may or may not be. But that's a really good point.
Last question about conventional loans, guys. I know I'm beating this conventional loan in the head,
Mhm.
but I just want to make sure people understand. Down payment. Do I need 20% for a conventional loan?
No, down payment for a conventional loan can go as low as 3%.
Woo,
So it's common
3%.
for 3 or 5%, depending on if you're a first time home buyer or not.
Mm,
Um,
Yeah.
so that is black and white. 3 or five
Mhm.
percent, as low as 3%.
So guys out there, if you're looking at a house, $200,000, right?
Mhm.
3% down. You talking about $6,000 down payment,
Mhm.
correct?
Right.
I got the math
Mhm.
right.
Yep.
That's
You
the
got the
that's the
math
Ooh,
right.
math is mathing.
it's mathing, right? All
Yep,
right,
it's
let's
math.
next question. Next question. Let's move on to FHA loans, guys. I
Okay.
know I talked a lot about conventional FHA loans. Why are FHA loans still relevant? Okay, why are FHA loans still relevant? Let's talk about FHA loans.
Okay. So yeah, I mean, I think the number one thing is FHA loans offer um, more buying power for borrowers, and then
Mm,
also they offer um, lower credit score requirements. So for an
Mhm.
FHA loan,
it's
most
good.
lenders would look at putting down the minimum down payment of 3.5%. Your credit score needs to be at a 580 or higher. Now, are you going to get approved at that? It's, again, it's not black and white, but that's the minimum score for the minimum down payment of 3.5%. However, you can go as low as a 540 credit score with majority of lenders. We do it here at NAV in terms of getting approved at 540. But again, there's some
540.
and
Did you say
540, but you're gonna have to
540?
put more. But it's gonna be a requirement. You're gonna have to put at least 10% down, um, and then it's also gonna require that you should have some additional money to show some
Okay.
reserves and all kind of other goodness that needs to go along with that.
Okay.
But
I
Mhm.
just want to make sure we clear on that.
yeah, yeah,
You
yeah.
said
So it's not
540?
it ain't for everybody. But we can go as low as
540.
540. It ain't
540?
for
You said
everybody.
540?
Mhm.
You said 540?
540.
I'm sorry.
That's
540.
what I said. Come a little closer. Come
540.
a little closer.
540. 540 credit
540.
score. 540
Yeah,
credit
yeah.
score.
But typically, guys, I mean, you would still it in most cases you would want to be 580 or higher, so you can put down a minimum down payment of 3.5%. And FHA is still a strong loan option. It's backed by the
Right.
government, so it's secured and backed by our government. It's not private investors or anything like that. So,
Mm,
with that being said, typically the government may have more restrictive, guidelines and things. That's when you were talking about the appraisal. The difference between a conventional appraisal and a FHA appraisal or a VA appraisal, which is also backed by the government, they're going to be a little bit more tedious about the condition of the property that you're buying, the expectations of the roof, the flooring, the things that. So they're going to be certain things that are just honed in more than a conventional appraisal may require. So that's a high level overview of why FHA loans are still strong in 2026.
mm, I like FHA loans too, guys. You know what I'm saying? A lot of my clients use FHA loans. They love that 3.5% down payment. It's
Mhm.
3.5%, correct? Three and a half
Three and a
percent.
half.
Right.
All right. They love that 3.5% down payment. The option to combine that with down payment assistance, if I'm not
System.
mistaken, as well.
Mhm.
I see a lot of the combos with that. It's good, but like I said, understand that when that FHA appraisal happens, this is something that happened recently too, guys. I had a situation where um uh my client had a property under contract, and the home didn't appraise for the agreed price that we had on
Mm-hmm.
contract. Understand, with FHA loans, that appraisal will stick with that house for 6 months.
Mhm.
This is
Yep.
Okay.
correct.
So for you sellers out there, just want to talk to y'all for a brief second. If you decide, hey, I'm gonna just pull it off the market, or I'm not gonna sell it or whatever because
Mhm.
it didn't appraise, just understand that FHA appraisal will. So if another buyer that's a FHA buyer comes and tries to buy that house, understand within that 6 month period, it's still going to have to abide by that appraisal that the original buyer had. Okay. So
Mhm.
just want to make sure they understand that when it comes to FHA appraisals. All right, I think we might can get one more in here, guys. And I want to hit these two. We might can hit these two at the same time.
Okay.
VA loans and USDA loans, they have something in common, but I'm gonna let the professionals talk about why someone should be considering these loans and if they're eligible or not.
That's good, and I'll take that one. So I would say VA definitely has always been beneficial. We thank, all the veterans and current active duty servicemen and women out there for the service that they do provide for our country here. But VA and USDA, excuse me, are 100% financing. So that's
Mm,
a true benefit. And so when I say 100% financing, that means that there's zero down, so that you don't need to put
0.
anything down for the down payment
Like you're throwing up
at
a
all
nuke.
whenever you're doing a
0.
USDA or a VA loan. Contrary to popular belief, USDA loans are making a comeback. They used to be super popular, I would say during COVID or right before COVID, and then they
Mm,
kind of went away some. But I think the reason that USDA is definitely becoming a lot more popular, especially here in the Charleston area, is that
mm,
within the city limits is getting too concentrating. Like so many people are moving here, and a lot
mm,
of people like, I don't want to live on top of each other. I don't want my neighbors next to me. I want to live more in the country or in the rural side. So they're branching out further to Ridgeville and St. George, even to Orangeburg and Orangeburg County in general, which USDA covers majority of that area. So it's definitely an affordable cost for people because you tend to get a little bit of lower interest rates with both USDA and VA loans, in addition to we mentioned on a conventional loan about that private mortgage insurance. For VA and USDA, there's no private mortgage insurance. Now, VA has their funding fee, and USDA has something called a guaranteed fee, but both of those
mm,
fees are much less than what private mortgage insurance would be, which would then make that mortgage payment a lot lower. And a lot of
mm,
people are attracted to that because of just the affordability in general.
mm. Good. All right,
Mhm.
man. That went fast. We
It
at the top.
did.
We we gotta go. So I just want to say, guys, that was a great discussion. We have a couple more. We might do a part two. I don't know. If y'all want to know some
Yeah,
more
I think we
information.
should do a part two. Definitely
Yeah.
hitting the down payment assistance and the non-traditional,
Uh,
non-QM type financing. I think that would
whew,
be a great topic to talk
I,
about next week.
yeah. I mean, these are very, very important for if you're thinking about buying a home in 2026. I truly think you need to tune in or reach out to us to see if we could help you pertaining to the right loan for you. Okay.
Okay.
So guys, we're gonna end this right now. Go Patriots, and I hope to see you guys again next week. Teach Me Tuesday, same time, same place.
Yeah. Enjoy your birthday. Once again, happy birthday.
Yeah,
See
bro.
you guys
Appreciate it.
next week.
Thank you.
Bye.
Blessings.